As a legal professional and economist, I've spent my career examining the gap between what numbers suggest and what they actually reveal about financial reality. In the second quarter of 2025, American household real estate wealth reached $48.6 trillion. That's the highest figure ever recorded in this country's history. Financial media celebrated this milestone as definitive proof of economic resilience, as evidence that the middle class had survived pandemic disruption and persistent inflation, with their wealth intact and growing. But when you understand how wealth is actually calculated, when you read the legal frameworks governing property valuation and the economic mechanisms that turn home equity into actual purchasing power, that $48 trillion figure tells a very different story. Home price appreciation slowed to 1.1% year over year in the second quarter of 2025. That's the lowest growth rate we've seen in over a decade, excluding only the immediate aftermath of the 2008 financial crisis. More critically, the carrying costs of homeownership grew 8.3% in that same period. Property taxes, insurance premiums, maintenance expenses, and utility costs all accelerated dramatically while the underlying asset itself barely appreciated. This creates what I call the wealth illusion. On paper, American homeowners appear wealthier than ever before. In practical economic reality, they're being systematically impoverished by the costs of maintaining that apparent wealth. Today, I'm performing an economic autopsy on 2025, examining the specific legal and financial mechanisms that transformed record household wealth into what may become the largest middle-class wealth destruction event since the Great Depression. We're going to examine 4 distinct layers of this crisis. First, the locked equity trap that prevents homeowners from accessing their paper wealth. Second, the legal framework failures that allow carrying costs to bypass statutory protections. Third, the insurance market breakdown that's making homes unaffordable to own. And fourth, the generational exclusion that's preventing wealth formation for the next generation entirely. If you own property, if you're considering purchasing, or if you're trying to understand why a 6-figure income no longer provides financial security in this country, the next 30 minutes will show you the forensic mathematics that mainstream analysis is deliberately avoiding. Let me start with the first mechanism destroying wealth in 2025, the locked equity trap. This is where the fundamental deception embedded in that $48 trillion wealth figure becomes impossible to ignore. The Federal Reserve calculates household real estate wealth using a straightforward formula that appears mathematically sound on the surface. They take the total market value of all residential properties in the United States and subtract outstanding mortgage debt. The difference represents net housing wealth. By this measure, American homeowners gained approximately $2 trillion in equity during 2025 as property values continued their decade-long climb from the post-2008 recovery. But this calculation contains a fatal assumption that anyone with legal training immediately recognizes as problematic. It treats housing wealth as if it were liquid, as if that equity could be accessed and deployed without friction, without cost, without legal constraint. It fundamentally assumes that the number appearing on your county assessor's website or your Zillow estimate represents actual purchasing power, rather than a theoretical construct that may never materialize as spendable wealth. Here's the brutal reality that the $48 trillion celebration conceals. During the same quarter that household wealth reached its historic peak, mortgage refinancing volume collapsed to its lowest level since 1995. That's a 30-year low in a metric that directly measures homeowners' ability to convert equity into usable capital. Home equity line of credit originations fell 37% year over year in 2025. These are the credit instruments that allow homeowners to borrow against accumulated equity for renovations, debt consolidation, or emergency expenses. The market for these products essentially froze. Cash-out refinancing, which allows homeowners to replace their existing mortgage with a larger loan and pocket the difference as liquid cash, dropped to just 11% of all refinance activity. In a normal market environment, cash-out refinancing typically represents 40 to 50% of refinance volume. The collapse to 11% represents a near-total shutdown of equity extraction. Why does this matter so profoundly? Because locked equity isn't wealth in any meaningful economic sense. It's a number on a quarterly statement that you cannot spend, cannot invest in income-producing assets, and cannot use to improve your actual standard of living. When interest rates jumped from 3% to 7% between 2021 and 2023, they didn't just make new mortgages expensive for prospective buyers. They created what economists call a lock-in effect that transformed existing homeowners into prisoners of their own accumulated equity. Let me show you exactly how this trap functions with a specific household scenario. Picture a family that purchased their home in 2019 for $375,000 with a conventional 30-year fixed mortgage at 3.5%. Their monthly principal and interest payment is approximately $1,680. This is a manageable payment that represented 28% of their gross monthly income at the time of purchase, well within traditional affordability guidelines. Today, in late 2025, that same home might appraise for $520,000 based on comparable sales in their neighborhood. On paper, assuming they've been making regular payments and building principal for 6 years, they've accumulated approximately $145,000 in equity. That's a substantial number that looks impressive on their net worth statement. But that equity is completely inaccessible to them at any reasonable cost. If they wanted to extract that wealth through a home equity line of credit in the current market environment, they'd pay interest rates averaging 9.2%. That's nearly triple their original mortgage rate. The monthly interest cost on even a modest $50,000 draw would be $383, consuming a significant portion of their discretionary income just to access their own accumulated wealth. If they attempted a cash-out refinance to extract a larger portion of that equity, they'd be required to replace their 3.5% mortgage with a new mortgage at current rates of 7%. This would increase their monthly payment from $1,680 to over $2,700, an increase of more than $1,000 monthly. That's an additional $12,000 annually, or roughly 15% of their gross household income, sacrificed permanently just for the privilege of accessing their own equity. The legal structure of the American mortgage system, specifically the 30-year fixed-rate instrument that dominates residential lending and has for decades, was designed during an era of relative interest rate stability. The framework assumes that homeowners would periodically refinance as rates declined over economic cycles, extracting equity and reducing payment burdens in a continuous cycle that allowed wealth to be both accumulated and accessed. But we've entered what appears to be a permanently higher rate environment that breaks this foundational assumption completely. Federal Reserve projections, the ones published in their quarterly summary of economic projections, suggest rates remaining in the 6 to 7% range through at least 2027. This means the lock-in effect persists not for months, but for years, potentially for the entire remaining life of existing low-rate mortgages. This is the first layer of the wealth illusion. Americans believe they're wealthier because their home values increased and their equity balances grew. In functional economic terms, they're actually poorer because they cannot access that wealth without destroying their monthly cash flow and permanently impairing their financial position. That's the locked equity trap, theoretical wealth that cannot be converted into practical purchasing power. But there's a second mechanism at work that makes this even worse. The carrying costs of maintaining that locked equity are accelerating at rates that far exceed both home price growth and wage growth. Let me show you how legal protections that exist on paper are failing in practice. The second layer of wealth destruction in 2025 is the systematic acceleration of carrying costs, and this is where legal frameworks at the state and local level are revealing themselves as illusory protections rather than meaningful safeguards. Property tax revenue across the United States increased by 6.8% in 2025. That's the largest single-year jump since 2007, and it occurred during a year when home price appreciation was essentially flat at 1.1%. This should be mathematically impossible if the legal protections that states claim to provide actually functioned as advertised. Most states have constitutional provisions or statutory caps limiting annual property tax assessment increases. These laws exist specifically to protect homeowners from being priced out of their properties through rapidly escalating tax bills. But the 2025 data proves these protections are failing systematically, and understanding why requires examining the gap between legal text and practical implementation. Let me start with Texas, which markets itself aggressively as a low-tax state with strong homeowner protections. State law caps annual homestead assessment increases at 10%. On the surface, that sounds like robust protection against runaway tax bills. But you need to understand the mechanism in practice to see why it fails. If your home was assessed at $300,000 in 2023 and the market value surged to $450,000 by early 2025 during the brief appreciation spike before prices stabilized, your taxable assessment doesn't immediately jump to reflect that market reality. Instead, it increases by the maximum allowable 10% annually, catching up to market value over a multi-year period. This creates what I call the tax appraisal lag. During boom periods, this lag actually protects homeowners from immediate tax shock. But during market corrections, or even during periods of price stability like we experienced in 2025, homeowners continue paying taxes based on valuations that no longer exist in the current market. Your home might be worth $420,000 today based on actual comparable sales, but you're paying taxes as if it's worth $450,000 because that's where the assessment calendar says you are based on historical data. California provides an even more instructive example of how legal protections fail in practice despite appearing strong on paper. Proposition 13, passed in 1978 and enshrined in the state constitution, limits property tax increases to 2% annually as long as ownership doesn't change hands. This is considered one of the strongest homeowner protection laws in the entire country. Advocacy groups point to Proposition 13 as the gold standard for taxpayer protection. But here's what Proposition 13 doesn't protect against, and this is the critical gap between legal text and economic reality. It provides zero protection against special assessments, zero protection against Melrose Community Facilities district fees, and zero protection against voter-approved local bond measures that bypass the Proposition 13 cap entirely. A homeowner in Riverside County might look at their tax bill and see a base property tax of $4,200, which appears reasonable and consistent with the Proposition 13 protection. But that same bill includes an additional $2,300 in special assessments for infrastructure improvements, bond payments for school construction debt, and community facilities district fees that the Prop 13 protection provides absolutely no shield against. Their effective property tax isn't the 1.25% that Proposition 13 theoretically guarantees. It's closer to 1.9% when you include all the legally permissible add-ons. And that effective rate increases annually regardless of whether their home value is rising, falling, or remaining stagnant, because special assessments and bond obligations operate on completely separate legal authority from the Prop 13 base cap. Florida presents perhaps the most dramatic recent illustration of legal protection failure in action. The Save Our Homes constitutional amendment caps assessment increases at 3% annually for homestead properties. That's even more restrictive than Texas's 10% cap. It should provide even stronger protection. But Florida's catastrophic insurance crisis, which I'll examine in detail in the next section, has forced local governments to dramatically increase property tax rates themselves to fund infrastructure hardening against hurricanes, emergency services expansion, and climate adaptation measures that insurance companies are no longer willing to cover privately. So, while your assessed value might increase by only the constitutionally limited 3%, your actual tax bill increases by 7 or 8% because the millage rate itself, the tax rate applied to that assessed value, is climbing to fund services that must be provided regardless of property value trends. Across every state I've examined in preparing this forensic autopsy, the pattern is identical and the lesson is clear. Legal protections exist on paper. They're marketed to voters as homeowner safeguards during election campaigns. State and local politicians campaign on these protections as proof of their commitment to taxpayer relief. But the actual fiscal pressure finds alternative pathways that statutory caps cannot control. Special assessments, bond obligations, fee increases, millage rate adjustments. The revenue extraction continues regardless of the legal framework supposedly preventing it. The result in 2025 was that 6.8% increase in property tax revenue extraction from American households whose nominal home values increased by just 1.1%. The gap between cost acceleration and asset appreciation is where wealth gets systematically destroyed, and legal frameworks are proving completely inadequate to prevent that destruction. So we've established the locked equity trap that prevents you from accessing paper wealth, and the legal framework failure that allows costs to accelerate despite statutory protections. But there's a third mechanism at work that's even more severe. The insurance market breakdown that's making homeownership financially unsustainable, regardless of whether you can qualify for the mortgage or afford the property taxes. Let me show you what's happening to insurance markets across the United States. The third layer of the wealth destruction mechanism in 2025 is homeowners' insurance market breakdown. and this represents a fundamental category shift from rising costs to the potential elimination of insurability itself in major metropolitan areas. Homeowners insurance premiums increased 21% nationally in 2025. That's the largest single-year jump ever recorded outside of immediate post-catastrophe adjustment periods following events like Hurricane Katrina or the 2017 to 2018 California wildfire seasons. But that national average figure actually conceals the true severity of the crisis in specific states that are transitioning from expensive insurance markets to functionally uninsurable markets. Texas saw average annual premiums reach $6,140 for homes valued between $400,000 and $500,000. That represents a 54% increase from 2020 levels in just 5 years. Florida's average premium hit $7,800 annually. Louisiana exceeded $8,200. These aren't just expensive markets anymore. These are markets approaching actuarial insolvency, where the expected annual losses exceed the premiums that any economically rational homeowner can afford to pay. Let me explain the legal framework creating this insurance crisis, because understanding the statutory constraints is essential to recognizing why this problem has no easy solution. Most states require mortgage servicers to escrow insurance premiums as a condition of loan approval and ongoing servicing. This is a legal mandate embedded in standard mortgage contracts. It means homeowners cannot simply drop coverage to reduce their monthly costs, even if they wanted to personally accept that catastrophic risk. The lender's security interest in the property legally mandates continuous coverage as long as any mortgage debt remains outstanding. But state insurance regulations, with very few exceptions, don't cap premiums the way they might cap utility rates or medical costs in certain regulatory contexts. Insurance commissioners can deny rate increase requests if they find them actuarially unjustified. But if an insurer can demonstrate through loss data and reinsurance costs that a particular rate is necessary for solvency, regulators generally must approve it. This creates a perfect extraction mechanism that homeowners are legally powerless to escape. They're required by mortgage contract to purchase a specific product. That product's price is set by actuarial calculations that increasingly reflect climate volatility, reinsurance cost spikes, and litigation expense inflation. And homeowners have no legal recourse to refuse the product, no ability to negotiate the price, and no regulatory protection capping what they can be charged. They either pay the premium, sell the home and relocate, or enter mortgage default. Those are the only three options the legal framework provides. The Insurance Information Institute, which is the industry's primary research and data organization, published analysis in late 2025 showing that 7 states now have homeowners insurance markets officially classified as being in crisis or severe distress. These are California, Florida, Louisiana, Texas, Oklahoma, Colorado, and Arizona. An additional 14 states are classified as elevated risk, meaning they're exhibiting early warning signs of potential market breakdown. That means 42% of the U.S. population lives in a state where insurance costs are rising faster than wages, faster than home values, and faster than any other component of household expenses. This isn't a regional problem anymore. This is a national crisis affecting nearly half the country. For a household earning $96,000 annually, which is the national median, an $8,000 annual insurance premium consumes 8.3% of gross income. That's before any mortgage payment, before property taxes, before utilities or maintenance, or any other housing-related expense. Just the insurance cost alone is approaching the percentage of income that previous generations spent on their entire housing payment, including mortgage principal and interest. And unlike property taxes, which at least theoretically fund public services and infrastructure that maintain or potentially increase property values over time, insurance premiums purchase only risk mitigation. You pay $8,000 annually for nothing except the privilege of not losing everything if a specific catastrophe occurs. That payment builds no equity in your property, funds no improvements to your home or neighborhood, and provides no tangible benefit beyond avoiding potential disaster. It's pure cost with zero return. It's a wealth extraction mechanism that provides no corresponding wealth creation. The actuarial reality driving these premium increases is straightforward and essentially irreversible. Climate volatility has increased the frequency and severity of insurable catastrophic events. Reinsurance markets, where primary insurers buy coverage to protect themselves against catastrophic loss years, have repriced risk dramatically following consecutive years of massive payouts. And litigation costs in states like Florida and Louisiana have exploded as homeowners sue insurers over denied claims, creating a legal environment where claims administration expenses now rival actual loss payments. None of these three drivers are temporary or cyclical. Climate patterns aren't reverting to pre-2020 stability. Reinsurance markets aren't returning to pre-2022 pricing. Litigation environments aren't becoming less adversarial. The cost structure that produces $8,000 annual premiums is permanent, not transitional. So we've established three mechanisms now. The locked equity trap that prevents wealth access. The legal framework failure that allows costs to bypass statutory protections. The insurance market breakdown that makes ownership financially unsustainable. But there's a fourth layer to this crisis that's actually the most structurally concerning because it reveals that the wealth destruction isn't just affecting current homeowners. It's preventing wealth formation for the next generation entirely. Until this point, I focused primarily on the mechanisms affecting existing homeowners, the families trapped by locked equity and rising costs. But the 2025 economic autopsy reveals something even more structurally concerning about the $48 trillion wealth peak. The wealth destruction isn't limited to current owners. It's preventing wealth formation for the next generation entirely. The homeownership rate for adults under 35 years old fell to 37.4% in 2025. That's the lowest level recorded since the Census Bureau began systematically tracking this metric in 1982. This isn't cyclical variation that will reverse when economic conditions improve. This is structural exclusion from the primary wealth-building mechanism that created the American middle class over the past 70 years. Here's the legal and economic reality creating this exclusion, and why it represents permanent rather than temporary displacement. Previous generations, the baby boomers who purchased homes in the 1970s and 1980s, and even Generation X buyers in the 1990s and early 2000s, purchased homes with mortgage rates that ranged between 4 and 6% in normal economic conditions. Property tax burdens averaged 0.8% of home values annually. Insurance costs averaged around 0.3% of property values annually. Total carrying costs beyond the mortgage payment itself averaged around 1.1% of property value annually for those earlier generations. These were manageable, predictable costs that households could budget for with reasonable certainty. In 2025, that same calculation produces completely different results. Property taxes now average 1.2% of property values annually. Insurance costs average 1.8% of values. Maintenance expenses have increased 43% since 2019 due to labor shortages and material cost inflation driven by tariffs and supply chain disruption. Total carrying costs now average 3% of property value annually before you even make a mortgage payment. On a $400,000 home, that's $12,000 every single year just in property taxes, insurance, and basic maintenance required to prevent the property from deteriorating. For someone earning $60,000, which is the typical salary for workers aged 25 to 34 who are earlier in their career trajectories, that $12,000 in carrying costs represents 20% of gross income consumed just by maintaining the property. That leaves virtually nothing for mortgage principal and interest payments, which would add another $24,000 annually at current rates on a conventional mortgage. The mathematics exclude homeownership completely for median young workers. The psychological and social impact of this structural exclusion is already visible in household formation data that demographers are tracking with increasing concern. Adults aged 25 to 34 living with parents rather than forming independent households reached 23% in 2025. That's up from 17% in 2019, a 6 percentage point increase in just 6 years. Marriage rates for the same cohort fell to 31% in 2025, down from 39% in 2019. That's an 8 percentage point decline in marriage formation during prime family building years. Birth rates declined to 1.5 children per woman in 2025, well below the 2.1 replacement level necessary for stable population without immigration. This is the lowest birth rate in American history. These aren't isolated cultural shifts happening independently of economic conditions. These are direct adaptations to a housing market that has become mathematically incompatible with middle-class family formation. When housing costs consume 50% of income for median earners and 60 to 70% for young professionals still climbing salary ladders in their careers, the traditional milestones of adulthood become unattainable luxuries rather than expected life stages. Young adults cannot afford to move out of their parents' homes because rent consumes 40 to 50% of their income and saves nothing toward future home purchase. They delay marriage because wedding costs and household formation require capital they cannot accumulate. They delay or forgo having children because raising children in rental housing with no yard, no stability, and constant relocation risk is incompatible with how they envision family life. The wealth destruction of 2025 isn't just destroying the balance sheets of current homeowners who saw equity evaporate or became trapped in unsustainable carrying costs. It's destroying the possibility of future wealth creation for millions of younger Americans who will spend their peak earning years paying rent that builds landlords' equity instead of their own, funding other people's retirement accounts instead of building their own wealth. So now you understand all four mechanisms: the locked equity trap, the legal framework failure, the insurance market breakdown, the generational exclusion. Let me show you what all of this means when you synthesize it into a single, coherent analysis. This is where individual pressures become systemic crisis. Here's my forensic conclusion about what the $48 trillion wealth peak actually represents. This isn't a celebration of household prosperity that vindicated pandemic-era housing policies. It's the terminal diagnosis of an economic model that has exhausted its mathematical viability. The American housing wealth machine functioned successfully for roughly 70 years based on three fundamental assumptions that policymakers, lenders, and households all took for granted. First, that interest rates would remain low enough or decline frequently enough to make mortgage debt continuously serviceable and refinanceable. Second, that carrying costs would remain a manageable and stable fraction of property values over time. Third, that income growth would keep pace with housing cost growth, maintaining affordability for each successive generation entering the market. All three of those foundational assumptions broke simultaneously between 2022 and 2025. And when all three fail at once, you don't get cyclical correction, you get structural collapse. Interest rates have settled into what appears to be a permanently higher range between 6 and 8%. That's roughly double the 2010 through 2021 average that an entire generation of homebuyers came to view as normal. Federal Reserve projections suggest this range persists through at least 2027 and potentially longer if inflation remains persistently above the 2% target. Carrying costs have completely detached from property values. They're growing at nearly triple the rate of home price appreciation. Insurance, property taxes, and maintenance expenses are accelerating at 8 to 10% annually, while home values grow at 1 to 2%. That gap is unsustainable and widening. And wage growth, while positive in nominal terms at 2 to 3% annually, has been completely overwhelmed by the acceleration of housing-related expenses. The gap between income growth and cost growth reached 6 percentage points in 2025. That's not a temporary dislocation, that's structural divergence. Let me give you the specific data points that prove this is structural failure rather than cyclical correction that will naturally reverse when some external condition improves. The gap between median home prices and median affordable home prices based on median incomes reached $88,000 nationally in 2025. That's the largest affordability gap ever recorded in American history. It exceeds even the 2006 housing bubble peak by 32% when you adjust for inflation. And critically, the 2006 gap was driven by prices rising too fast. The 2025 gap is driven by carrying costs rising too fast, even as price appreciation slowed to barely above zero. Mortgage payment to income ratios hit 39% for new borrowers in 2025. That's the highest level since 1984, when interest rates briefly exceeded 15% during the Volcker Federal Reserve's inflation-fighting campaign. But unlike 1984, when rates soon declined dramatically and restored affordability within 2 years, current rate projections from the Federal Reserve suggest this higher range persists indefinitely. Most critically, the percentage of income consumed by total housing costs, not just mortgage payments, but the complete burden of property taxes, insurance, maintenance, utilities, and all housing-related expenses, reached 47% for median earners who purchased homes in 2024 or 2025. That's 14 percentage points above the 43% qualification ceiling that lenders theoretically enforce. It's 22 percentage points above the 25% debt-to-income ratio that financial advisors historically recommended as the ceiling for sustainable homeownership. This is what I mean when I call $48 trillion the wealth illusion. That number represents the aggregate market value of homes that their owners cannot afford to maintain long-term, cannot afford to sell without realizing devastating losses, and cannot pass on to the next generation because carrying costs have made them mathematically unaffordable for younger buyers earning median wages. The families experiencing this crisis aren't failing due to poor financial decisions or irresponsible behavior. The economic model failed them. The promise embedded in American housing policy for 70 years was that homeownership would build wealth, provide security, and create intergenerational prosperity that each generation could pass to the next. What actually materialized in 2025 was a system where nominal wealth increased on paper, while actual financial security deteriorated in practice, where equity accumulation became meaningless because it couldn't be accessed without financial self-destruction, where the next generation was systematically excluded from the wealth-building mechanism entirely, trapped in permanent renter status despite earning middle-class incomes. This is the wealth illusion in its complete form. Record household wealth that cannot be accessed, cannot be maintained, and cannot be transferred. $48 trillion in paper prosperity masking the systematic impoverishment of the American middle class. In the next forensic autopsy in this series, I'm examining the specific metropolitan areas where this wealth destruction is most acute and most visible. The cities where $48 trillion in paper wealth is actively transforming into the largest middle-class equity wipeout since the Great Depression. Austin, Texas, where tech sector employment collapsed while carrying costs accelerated. Tampa, Florida, where insurance markets are approaching true actuarial insolvency. Phoenix, Arizona, where water scarcity compounds housing unaffordability. Those city-level autopsies will show you not just that the system is breaking nationally, but exactly how it breaks at the local level where families actually experience the financial consequences in their daily lives. Subscribe to Uncover the Cities. This is where we examine the legal and economic frameworks that govern your net worth, the mechanisms that shape your financial future, the systems that mainstream analysis either fundamentally misunderstands or deliberately obscures to maintain comforting narratives. I'm a legal professional and economist applying forensic methodology to the housing crisis that's destroying middle-class prosperity in real time across this country. The data doesn't lie even when the marketing does. The $48 trillion wealth peak isn't prosperity. It's a debt trap masquerading as success, and 2025 will be remembered as the year that illusion became impossible to sustain. This analysis is provided for informational and educational purposes only. It does not constitute financial advice, legal advice, or investment recommendations. Consult qualified professionals before making any housing or financial decisions.